Morning, and thank you for joining the Laybuy Group Holdings first half FY 2022 results and November trading update investor webinar. I am Jade Morgan, and today I am joined by Laybuy's Managing Director, Gary Rohloff, and our Chief Financial Officer, Katrina Kirkcaldie, who will be presenting the first half FY 2022 results and provide a November trading update, which was lodged with the ASX this morning. To ask a question throughout the presentation, please use the Q&A function at the bottom of the screen. Katrina, I will pass on to you.
Thanks, Jane, and good morning, everybody, or good afternoon, depending on what side of the Tasman you reside. Gary and I are very pleased today to be able to present to you the results for the half one September 2021 period, as well as giving you an update of the October and November results, which I'm pleased to advise has seen continued momentum off the back of what was a very strong half. As we presented last week in the market announcement that went out, we saw revenue growth of 60% year on year for the period ended 30 September. The revenue line certainly moved in line with GMV, which was pleasing at that 60% mark. This growth has continued into October and November, with us delivering 57% year-on-year growth. That has come largely from the UK, which has seen continued growth at 73% for the October-November trading period. Active customers have now reached 930,000 across the group, and active merchants at 12,500. I will now pass over to Gary, who will give some of the detail in the regional performance updates.
Thanks very much, Kat, and good morning, good afternoon, everybody. Great to have you on board, and also great to be able to share some very positive results for you yet again as we update the market on Laybuy's progress. As Kat has alluded, our half-year growth up 60% year on year in GMV, 57% up in active customers, and a whopping 86% up in active merchants. So all of these charts moving the right way and consistent with what we are trying to achieve, which is continuing our rapid growth across all three markets in which we operate. Our October and November results are very, very pleasing for us, as you will see on the chart on your screen right now, making a record month for us of $96 million, which, when you look at November last year at just under 70 million, is a significant uplift for us. The UK up 73%, and in fact in October was up a whopping just over 100%. We are comping in November a very large increase last year in the UK when we added Wilco into the mix, but we've added to that again this year with a significant uplift in the UK in November for a merged 2-month growth of 73%. The ANZ market is one that we don't ignore and continues to deliver for us yet again, up a nice 35% year on year across that 2-month period. The UK on a half-year basis up 100% on the same half last year. Active customers up just under 100% at 90% year on year, and active merchants up 332%. So the business continues to grow rapidly. We are adding new and active merchants at a great rate, and that's a credit to our sales team and, of course, the affiliate program that we have opened up, which is seeing the likes of Boots, of Amazon, of B&Q and River Island coming into our mix and adding significantly to our GMV and overall growth. Not forgetting Australia and New Zealand, as we've alluded, our half year up 32% in GMV, so the business continues to grow here. We're adding active customers up 19% and active merchants up 56%. We're bringing on some great brands out of Australia, and there's a lot more in the pipeline, and those will be announced. We are hopeful of some of those going live pre-Christmas, but certainly into Q4 of our financial year, there will be a lot more new merchants coming on board across the Australasian market. Our card technology is key to enabling this growth. As we've made you aware before, our Tap to Pay is a seamless in-store checkout solution for consumers and retailers, and we are opening up a number of stores across New Zealand, Australia and the UK pre-Christmas, and obviously going into the new year as well. Our app exclusives, as I've alluded, give us access to hundreds of the world's best brands, and they are really assisting us in driving this growth in the UK, making it very, very simple for consumers to shop at the likes of Acne, Amazon, Farfetch, B&Q, and Boots, just to name a few. This app exclusive is a very, very simple process for our customers. They're pretty sure that they know who they want to shop at through those apps, through the retailers on the app. We inject a virtual card and they pay in 6 interest-free, just as they do on a directly integrated solution. So this product's working very, very well. We have a dedicated team that looks after our app network, our app exclusive network, and we're already seeing the benefit of that team by the increase in commission rates on some of our key merchants by 3 times what we were achieving when we first launched. So that is proving to be a very lucrative and long and growing part of our business in the UK particularly. Our partnerships continue to grow. We have now 5 of the 7 super clubs out of this part of the world in our stable, adding Moana Pacifica just recently. And of course, as many of you are aware, we are the official buy now, pay later providers to Manchester United, Manchester City, and Arsenal. So really growing very rapidly, and continue to see the benefit of these partnerships as we are introduced to the fan base of all our sports clubs. And they in turn are starting to spend with Laybuy just beyond the clubs as well. I'm going to pass you back to Kat, who will talk through the financials, and then we'll close off our presentation with a little bit of the outlook as we head into Christmas, obviously, and then into Q4 of our financial year. Over to you, Kat.
Great, thanks, Gary. Just first of all, looking at the key financial and operating metrics at a high level here, we've already alluded to in the opening remarks that revenue increased 60% year on year in line with GMV. The income of 21.2 was largely derived out of commission revenue earned from merchants, with 43% of that revenue coming from the late fee. This has slightly come off from last year, and we would continue to expect that to happen as the market in the UK continues to mature. Revenue guidance for the full 12 months through to 31 March 2022 is expected to be in the range of 52.1 to 55.4 million. So certainly expecting a second half to outweigh the first half for the current financial year. NTM and defaults have slightly come down in the same period compared to last year at 1.5% and 2.6% respectively. However, it is important to note that we've seen a 57% increase in our active consumers, growing by 890k during that period. Repeat customers across the business continues to grow and is currently at 66%. Just moving on to the revenue momentum slide, you can see here that the revenue continues to grow at 21.3 for the half. It's a significant growth of 60% year on year, as I've already spoken to. NTM continues to move around a wee bit. As I say, we have done a significant grab of new customers in the last 12 months, and it has been reflected in some of our higher default rates we have seen come through. The commission rates continues to remain very steady at just over 3% for the half. The statement of comprehensive income isn't one I'll spend too much time on, just drawing out in the slide, as this is reflected in the statutory accounts, that the marketing and merchant expense is up year on year by 98%. It's important to note that our credit checking costs do flow through this line, and they're obviously a variable cost that moves in line with GMV growth. The incremental cost attributable to credit costs has been 600k for the half. Transaction expenses are payment processing costs, and they also move in line with GMV and remain pretty consistent at around 1.2% for the half compared to the prior half. We continue to invest in human resources with an additional 49 heads placed in our global business. The investment has been in customer support, the UK sales office, and our product and technology teams. We are anticipating further investment in product and technology teams over the next 12 months to enhance our tech platform. Other OPEX has remained relatively consistent across the two half periods. On to the statement of financial position. You'll see that there has been an overall improvement in the net asset position compared to the same half last year. This is largely due to the higher cash on hand balance and the increase in the receivables book. The net investment in the receivables book has grown 7.5 million for the two comparative periods. The UK receivables at the end of September were also 100% equity funded, as we were unable to draw down on the more recently closed debt facility with PFG. On a pro forma basis, with the outstanding available to draw from Kiwi Bank and the PFG facility, as at September, there was a further 18.7 million in liquidity available to Laybuy from these two debt facilities. On to the statement of cash flows. It's also important to note that that pro forma cash balance down the bottom there of 23 on a pro forma basis with those available to draw sums would have been 41.7 million. Further, I'd like to draw to the audience's attention, as Laybuy is regarded as a financing entity, the growth in the receivables book is regarded as an operating cash activity. We are well aware that some of our peers report this as an investing activity. Net receivables grew 7.5 million from 31 March to 30 September. Therefore, operating cash outflows for the group, excluding receivables growth, was actually only 21.1 million, not the 28.6 as reported in the statement of cash flows. Whilst we did not have the PFG facility available to us, it is important to note that the majority of the receivables book, therefore, were debt funded. Within the financing activities section, you will note that there had been a net repayment in borrowings for the period due to Laybuy repaying the VPC facility and equity funding this UK receivables loan book. The normalised EBITDA, you can see that we have seen further losses derived during the period, but I would like to note that the NTM positively contributed 1.6 million towards our operational overheads. We have continued to invest in our brand and driving increased customer awareness through our investment in merchant and marketing expenses, and as well as our people and human resources costs increasing 2.4 year on year. Just on to the last slide there for the finance section is just a reference to the debt facilities that Laybuy has available to us. You are all aware that we recently closed out the debt facility with Partners for Growth. I'll now hand back to Gary, who will now speak to the outlook.
Thanks very much, Kat. We wanted to just highlight a couple of things before going on to the outlook slide, and just on the growth that we have seen over recent weeks with some of the largest trading days of retail in the retail calendar. Singles Day was up 41% year on year, which is a massive increase when you think about how the market has moved for us, generally speaking. And Cyber Week up 30%. So we continue to take advantage of these key retail events to continue to grow the business, which has been great to watch as you see the business across New Zealand, Australia, and the UK benefit from these retail activities. But the UK is another story altogether and continues to deliver. We have opened up new sectors in airlines and health. Our app exclusives is now greater than 196 merchants, and we've also launched an ad marketplace, which helps us optimize and monetize our app revenues even further. We've got strategic partnerships that we have in the UK around airlines and health that include alternative airlines in that part of the world. We have increased our commission rates, as I alluded earlier, through our app exclusive merchants. And our UK team has delivered 100% GMV growth from FY21 through to FY22 first half. We continue to be recognised as one of the top three buy now, pay later providers in the UK. And I think it's really important that the market understands and that investors understand that the UK buy now, pay later as we know it in this part of the world is still in its infancy compared to the more mature ANZ region. And just a brief reminder, when we first landed in the UK back in August of 2018, no one was doing what we were doing in the market. One of our larger competitors, Klarna, had a product in the market that was a try now, pay later product. They did not have their pay it in 3 as they do now, buy now, pay later product in market. And so, in a very short space of time, the market has been educated on what we call buy now, pay later down here in Australasia, but the runway is still very, very long in that market. From a guidance perspective, we are still on target to achieve our annualized $1 billion in GMV, which will be up 60 to 70% on FY21. As Kat has alluded, our revenue is expected to grow between 60 and 70%, with the UK growth at 75 to 85. We have set up, as I said, a dedicated team to maximise the commercial arrangements and optimise revenue, principally through our app exclusive product, and that continues to accelerate that growth in the UK. And the partnerships that we have with various web platform and payment platform providers in the UK will continue to accelerate that growth alongside the affiliate marketing team that is adding new retailers every week as we look towards Christmas and then beyond into Q4 of our financial year. So really appreciate you being on the webinar today, and Kat and I are here to take and answer your questions as best we can.
Thank you for that, Gary. We've had a few questions come through, so I will jump into them. So recently the revenue growth target for FY 2022 was revised down to 60 to 70% from estimates earlier in the year. So can you talk a little bit about what has caused the team to revise these revenue expectations and what was not delivered in time to meet initial revenue guidance?
Thanks, Jane. I'll pick that one up, Gary. So yes, we have gone back out to the market with a revised revenue guidance. Whilst we have seen positive contributions from the affiliate channel, the overall commission rate is slightly lower than the traditional direct business. So we've seen some erosion, I guess, in the forecasts for that. There are some things we can do to improve that, and the team is actively working on that, and we are expecting that commission rate to come back up. We've also seen late fee revenue not be as big a contributor as what our internal forecasts had, hence us required to go to market to revise that market guidance.
Thank you, Kat. I'll actually stick with you as well. There's been a few questions just on the cash position. So what is the cash position like over the next year, and will there be need to raise more cash? And what confidence can you give that the business can operate for the longer term?
Yeah, thanks, Jane. So the pro forma cash balance at the end of September was the 41.7. Obviously, I've already spoken to how there wasn't a draw available for us from the PFG facility, so we were running on equity reserves for that time. It's important to note that as our receivables book grows, we are debt funded supported for that. So the LVR is 75% for the for the PFG facility and 80% for the Kiwi Bank facility. So as we continue to grow our receivables book, that is largely debt funded. Yes, there is an equity contribution that's required, but that is far lesser than what is required from the debt facilities. We're confident that we do have enough cash for the foreseeable future to deliver on our internal growth aspirations. However, we do continue to outperform, and so the business is actively looking at better ways to scale and better use liquidity.
Gary, I might pass this one on to you. There's been quite a few questions that have come through on the share price. So what is your view on the current share price versus the actual position of the business?
Well, thanks, Jane. And look, I can assure all our shareholders that the share price is very stressing for me as well as them. We continue to deliver on our promise of growth. We continue to outperform many of our competitors in what we're delivering, and yet the market does not seem to recognise that performance. As I've said on a number of occasions before, my focus and Kat's focus and the entire leadership team's focus is on delivering on what we said we would deliver, which is growth, particularly in the UK, and we continue to do that. My focus is all about delivering on that growth and demonstrating that Laybuy is and continues to be a leading buy now, pay later provider in the UK, and we want to cement that position over there. That's the best answer I can give. I cannot influence the market view of our company. I can only influence the outputs that we're achieving, and right now we're achieving them.
There's been a few questions actually, Gary, just on the UK. So are you seeing much competition in the UK, and are you seeing Zip much?
Look, the UK market is in its infancy, as I've alluded, and you will see that a number of new players are jumping up in the UK. We don't see much of Zip. I think people will reference their most recent announcements on their traction in the UK. And if a comparison was to be made, I think you would find that Laybuy has outperformed.
And just into competition then, so how will you compete versus large-scale competitors entering the market, particularly the banks?
Well, the interesting thing is I'm intrigued at the bank's position here, because one of the things that's become very obvious is when the banks roll out a buy now, pay later solution, they cannibalise their own database. They simply switch customers who are using the bank card into the bank's buy now, pay later solution. No consumer is going to switch banks just to avail themselves of a buy now, pay later solution with another bank because their bank doesn't have it. There are too many bank card agnostic providers like Laybuy that a customer can choose to operate with. I don't see the banks as a threat at all. In fact, I think they validate what we are doing, and we as a card agnostic provider actually provide the banks with a fantastic alternative to their own solution. So it'll be interesting to see how that goes.
Gary, I'll stick with you as well. There's been a few questions just about Ad Marketplace. So can you explain a little bit more about what Ad Marketplace is and how will it be monetized? And do you expect, and do you have an expectation regarding revenue uplift potential?
Yeah, look, the Ad Marketplace, I prefer not to go into too much detail publicly, because that is something our team has worked on to optimise the benefit of our affiliate program. But I'm very happy to talk on a one-on-one basis about how that all works. What that delivers, though, is a better revenue contribution from the affiliate program, which I'm sure we're going to see the benefit of as that affiliate program adds more to our overall GMV over the ensuing months and years to come.
Perfect. So there's another one that's popped up. So could you please reconcile the relatively flat GMV margins with your comments that app exclusives are a growing part of the business and are expected to come with higher margins?
Yeah, sure. So just to remind everyone, we only started the app exclusive program at the beginning of September. And we rolled that out and have taken advantage of the growth in GMV. We've learned rapidly what we need to do to influence or better influence and optimize the yield of the app exclusive program. And we are already starting to see the benefits of that through the early and latter part of November.
Kat, maybe one to you. So your cash burn rate seems to be increasing. Do you want to just comment a little bit on this?
Yeah, we are investing heavily in our human resources across the business. We've just spent the last 3 to 6 months really building out the UK sales team. John Gillen has done a fantastic job there. We've obviously put in a few extra resources or roles as well to support the affiliate channel. And as I made in comments to my presentation, we are expecting further investment in the human resources, particularly in the tech and product teams as well, because we're a fintech after all, and we feel that we need to be fast moving with our solution to better support both our merchants and our customers. We are well aware of our cash burn, and it's something Gary and I scrutinise daily. Unfortunately, until we get to a certain scale, we will continue to see operating trading losses.
Okay, and so referring to slide 5 of the deck that was lodged today, so March 21 through to August 21 saw relatively flat growth month on month. So given the new growth strategies in the UK, do we expect this month period in 2022 to be similar, flat, or month on month growth, or different?
Yeah, just looking at that, I would say that with what we are seeing as a contribution from affiliate and what I'm watching on my screen every day out of the UK right now, we're seeing more and more affiliate retailers being brought onto the platform and a greater contribution. There is a flattening of retail that I am somewhat worried about as we go into December, and I'm not sure how that will impact the first quarter of the new calendar year or our fourth quarter. What I think is generally accepted now is November is the new December in the retail calendar. That position of a decline in December or a flattening off in December is going to be exacerbated this year by the supply chain woes that all retailers are experiencing around the globe as a result of COVID. If, and this is a big if we are to see an ongoing extension of Omicron as a catalyst for further tightening of supply chains, etc., we may well see that come off more extensively in that first quarter than previous years. What I do see for Laybuy, though, is we will unquestionably continue to grow the business, particularly through the affiliate program and Tap to Pay, assuming stores are open and available to consumers.
Thanks, Gary. And what are you most excited about for the future for the next 3 to 6 months?
Oh, look, I'm just excited about the sector generally. I mean, as I've said on a number of occasions, we are still in our relative infancy in the UK, and it's an exciting market to be a part of. You know, the deals that have been done already in the market validate the fact that buy now, pay later is not a fad. We are an integral player in that ecosystem here in New Zealand. We are a player in the Australian market, and we intend to keep playing in that market. And we're a very significant player in the UK as well. It excites the hell out of me to see where we can take this business over the course of the coming months and years as we bed in this non-direct project, as we bed in the sales team in the UK, which is really kicking a lot of goals for us, and continue to scale the business. It's an exciting time ahead for us.
I think that is all we've got today. It looks as though we've actually answered all the questions that have come through. Katrina, Gary, thank you for your time, and thank you all for joining us today for the Laybuy Investor webinar. If we have missed any questions, please feel free to reach out via the contact details on the bottom of our ASX releases. But thank you all for joining us.
Thanks, Jane. I'll just pick up one that I've seen that I think would be worth addressing, if you don't mind.
Sure, absolutely.
There was a question that it seems that the market doesn't understand the strategic position in the UK, and do you expect that other players are looking at what Laybuy is achieving and seeing a low share price and perhaps considering a strategic deal? Look, I think the reality is Laybuy has carved out a significant position in the UK that is attractive to a number of potential suitors. Our focus is squarely on continuing to deliver what we're delivering over there. If that is appealing to a suitor, we will deal with that as and when it comes at us. But our focus is squarely on cementing that strategic position, because it is a big one. And as the number 3 player up there in that market, we continue to want to grow that position. So I hope that answers that question for the listener. Wonderful.
Thank you, Gary. I think we have covered it all now. And again, if we have missed anything, please feel free to reach out via the contact details on our website. And a copy of today's recording will be available online tomorrow as well.
And just one other comment, if you don't mind, Jane. I think Kat's done an outstanding job at presenting for us just what our cash requirement looks like, and the fact that the cash flow is skewed by the loan book growth. So the better the business actually does, that is the higher the growth, the worse the operating cash flow actually looks. But the reality is the business is much better. The operating cash flow, as the accounting standards require, is not really a good reflection of true cash flow, because the better we are, the higher the growth of the loan book. And that is debt funded largely. So I think it's important for people to understand that our growth is actually a really good thing for us. But thanks again, Jane. Thanks again, Kat, for your contribution, obviously. And thanks for everyone for listening to us and for your ongoing support.